This is an analysis from Alpha Business Media.
Welcome back to the deep dive. So today we're going to be shifting our gaze away from the usual noisy headlines. We're not talking about the latest liquidity crunch or, the daily ups and downs of the NEPSC. We are looking at something much, much slower, quieter. But if you're sitting in a boardroom of a commercial bank in Kathmandu right now, it's arguably the only thing that matters.
It really is. It's one of those shifts that, on the surface, it looks like boring regulatory housekeeping. Just a bunch of acronyms, compliance, deadlines. But when you actually open up the balance sheet and you look at the math, you realize the ground is literally moving beneath your feet.
And we are dissecting a report today titled Basel III Endgame, Why ROI Will Plummet.
And honestly, just looking at that title, it doesn't exactly scream party for shareholders, does it?
No, definitely not. If I had to give this report a mood, I'd probably call it the closing bell.
The closing bell? Yeah. The closing bell for an entire era of banking in Nepal. I mean, the era of easy money, where you could just leverage the balance sheet, lend against a piece of land, and just print profits. That is mathematically over.
Mathematically over. That's a huge statement. So our mission today, then, is to prove that. We need to unpack exactly why return on equity, or ROE, is facing this sort of structural decline, and why the only survival strategy is a pretty painful pivot from being a lender to being an advisor.
Precisely. And for you, the listener, this matters. It matters whether you hold bank stocks or run a business that needs financing. This isn't just about banks making a bit less money. It's about a fundamental change in how the entire Nepali economy gets financed.
So let's start with the catalyst here. The Basel III Endgame. I feel like Basel III has been a buzzword since, forever. Since I started following finance. Why is it suddenly an endgame?
It has been around a long time. Basel III was, it was born from the ashes of the 2008 global financial crisis. The whole idea was just to strengthen regulation so banks wouldn't blow up the global economy again. And in our context, the Nepal Rashtra Bank, the NRB, they championed this to prevent our own versions of those crises, like the real estate bubbles we saw back in, 2008, 2010.
Right. But for the last decade, it's felt more like a suggestion or, a moving target.
Exactly. We were in a transition period. Banks had flexibility. They could interpret the rules. They could use their own internal models. And frankly, they just had time to adjust. The end game means time is up. This is the final non-negotiable implementation phase.
So the training rails are coming off?
And the handcuffs are going on. The report actually describes it as a capital vice. And it is tightening around the bank's ability to generate returns.
Okay, let's get into the mechanics of this vice. To understand why profits are going to drop, we have to understand two acronyms, SPAR and RWA. Now, STAR is capital adequacy ratio. That's the money the bank has to keep in the vault to cover potential risks, right?
Broadly, yes.
Yeah.
It's the ratio of a bank's capital to its risk. But the real villain in this story, or I suppose the hero if you're a regulator, is that second acronym, RWA, risk-weighted assets.
Okay, this is the concept that I think trips people up. Because logically, if I lend you 100 rupees, I have 100 rupees of risk. But you're saying that's not how the regulator sees it.
No, and that's the crucial disconnect.
Yeah.
RWA is a mechanism to make different kinds of assets comparable based on their inherent danger.
Walk us through an example.
Sure. Let's say a bank lends 100 rupees to the government of Nepal.
Okay. Safest borrower in the country. Can't get any safer than that.
Right. So the regulator assigns that a 0% risk weight. For the purpose of calculating how much capital you need to hold, that loan effectively doesn't exist. It's free.
So 100 rupees lent counts as zero risk.
Correct. Now, take that same 100 rupees and lend it as an unsecured personal loan to someone walking right off the street. That's risky. The regulator might assign that say, 125% risk weight.
Whoa. So for the calculator, that 100 rupee loan actually counts as 125 rupees of exposure.
Exactly. And the higher that RWA number goes, the more capital, the more equity the bank has to lock away to cover it.
Yeah.
And here's where the vice really tightens. There are two things happening at the same time in this endgame. First, the risk weights are increasing for the exact sectors that Nepali banks are. Well, they're most addicted to.
And those are?
Commercial real estate and corporate exposure, the bread and butter of the whole industry.
So the stuff they have the most of is suddenly becoming heavier on their balance sheet.
Much heavier. But the second part is, I'd argue, even more critical. It's called the standardized approach.
That sounds incredibly bureaucratic.
It is. But what it does is it destroys a specific trick that banks used to play. See, previously, banks could use their own internal models to assess risk. They could look at a big corporate client and say, well, We've known this family for 20 years. Our model says they're safe. And they could dial down the risk weight. They could optimize their numbers.
So they're basically grading their own homework.
Precisely. And as you can imagine, they were very, very generous graders. The standardized approach just stops that cold. The regulator dictates the risk weight, period. No interpretation, no optimizing.
So the NRB is just walking in and saying, I don't care what your internal model says. I don't care how well you know this guy. This is a high-risk loan. Hold more capital.
Correct. And this leads us directly to the mathematical certainty that the report talks about. This is where we see the collision between what the regulators want and what the shareholders want.
Right. The regulator wants stability, which means holding more capital. The shareholder wants return on equity. And those two things are now enemies.
The correct enemies.
Okay, let's break down the math here. The report gives a really specific example, and I want to walk through it slowly because it really proves why a bank can run just as fast as before but still lose the race.
Let's do it. So imagine a typical commercial bank. Let's say they have NPR 100 billion in assets, mostly loans. And to support that, they have NPR 11 billion in equity.
Okay. 100 billion in assets, 11 billion in equity. Got it.
Now, the Basel III Endgame rules kick in. Because of those higher risk weights we just talked about on real estate, on corporate loans, and because they lost their internal models, the bank's total risk-weighted assets just inflate. Let's say for this example, they go up by 20%.
Wait, hold on. So they haven't lent any new money. They haven't taken on any new clients.
Not a single new piece of business. The exact same loans are sitting on the books. But suddenly, the regulatory weight of those loans has increased. And to maintain their mandatory capital ratio, the bank now needs NPR 13.2 billion in equity.
So they have to find an extra 2.2 billion rupees just to stand still.
Exactly. They either have to raise that money from investors, which, dilutes everyone, or they have to retain all their earnings and just stop paying dividends. But look what happens to the ROE.
Right. So ROE is net income divided by equity.
Right. So suppose that bank was making NPR 2 billion in profit. Their old ROE was 18.2%. That's a healthy number, really good number. But now you have to divide that same 2 billion of profit by the new, larger equity base of 13.2 billion.
The denominator got bigger, so the percentage has to drop.
It plummets. It goes to 15.1% automatically, just overnight.
That is brutal. It's like you're running on a treadmill and someone just cranked up the incline. You're working just as hard, earning the same profit, but your performance metrics just look worse.
It's actually worse than a treadmill. Because the natural instinct of a CEO in Nepal would be, okay, my margins are squeezed, my shareholders are angry, I need to grow, I'll just lend more money or I'll raise interest rates.
That seems logical, right? If I need more profit, why don't I just charge more interest or just, sell more loans to make up the difference?
Because it's a trap. Let's look at raising rates first. In Nepal, you have 20 commercial banks all fighting for a relatively small pool of high-quality borrowers. It is a hyper-competitive market. If you try to raise your rates to cover your capital costs, your best client just walks across the street to the next bank.
So you have absolutely no pricing power.
Zero. Okay, so plan B, just grow the loan book, lend more volume. But remember, under the Endgame rules, every single new loan you issue carries that heavier capital charge. So if you aggressively grow the loan book, you actually burn through your capital faster than the profit from those loans can replenish it.
Wow. So credit growth, which used to be the engine of profit, is now a capital drain.
Exactly. The engine is broken.
Yeah.
The faster you drive, the faster you run out of fuel.
And this brings us to another huge pillar of the Nepali banking system that this report says is basically crumbling. Collateral.
Yeah.
I mean, if you know anything about business in Nepal, you know that land is king.
It is the ultimate security. Absolutely.
If I have a building or a plot of land, I get a loan. It's almost automatic. The bank feels safe because if I go bust, hey, they take the land.
That has been the culture for decades. It's an asset-based proposition. Banks, historically, they haven't cared that much about cash flow analysis or business viability. They cared about the auction value of the collateral.
But the report says this model is obsolete. That's a strong word. Why?
Because Basel III is transaction-focused, not collateral-focused. The new rules look at the purpose of the loan, not just what's backing it up.
Okay, can you give us a concrete example of how that would play out?
Sure. The source material highlights commercial real estate. Under the new standardized rules, loans for commercial real estate development get a very high risk weight. We're talking 150% by default.
By default?
Yes. So imagine you're a banker. A client comes in, they have a prime piece of land in Durbar Marg, gilt-edged, the most valuable dirt in the country.
I would lend to them in a heartbeat. That is a safe bet.
In the old days, yes. But under Basel III, The regulator asks, what is the loan for? If the answer is to develop a commercial complex, you have to slap that 150% risk weight on it. It doesn't matter that the land is in Durbar Marg. It doesn't matter that the borrower is incredibly wealthy. The sector is deemed risky, so you have to hold a massive amount of capital against it.
So even a safe loan becomes expensive for the bank just to hold on its books.
Exactly. The collateral protects the bank from losing money. If the borrower defaults, sure. But it doesn't protect the bank from the regulatory cost of holding the loan. The collateral doesn't save you from the capital charge.
That is a seismic shock for a system where, something like 60% of all credit is backed by real estate?
At least. It forces them to rethink the fundamental question of what is a good loan.
And just to add insult to injury, there's this new capital tax mentioned in the report, operational risk. I found this fascinating because usually we talk about credit risk, the risk of not getting paid back. What on earth is this?
This is the cost of doing business in the modern age. Previously, operational risk, so the risk of your servers crashing, internal fraud, a cyber attack, even a big legal lawsuit. It was a bit abstract. Banks knew it existed, but they didn't really budget for it in terms of their equity.
And
Now, they have to calculate a specific capital buffer based on their historical loss data. It's what the report calls non-revenue generating capital.
So they have to take valuable shareholder money equity and lock it in a vault just in case they screw up.
Basically, it just sits there, doing absolutely nothing for the bottom line. It's insurance against incompetence or, just misfortune. And for banks that are still modernizing, maybe have weaker internal controls or outdated IT systems, this is a heavy, heavy burden.
Okay, let's take a breath and look at the landscape we've just painted. The basic math of ROE is broken, the land is king, collateral model is obsolete, and banks have to set aside dead money for operational risks. This sounds like a complete disaster scenario.
Well, if you do nothing, it is. But the report argues there is a way out. It talks about a strategic pivot.
It does, and this is the part I really want to drill into, because the report predicts that over the next 5 years, the industry is going to split into two camps, the consolidators and the pivots.
This is the fork in the road. This is the moment.
So let's talk about the consolidators first. These are the ones who they don't change.
These are the banks that cling to the traditional lending model. They'll try to muddle through. They'll think, we've always made money lending against land, so we'll just keep doing it.
And what does their future look like?
Stagnant. Their ROE will be stuck in the low double digits, maybe even single digits eventually. Investors will lose interest. And the report predicts we'll start to see a wave of defensive mergers.
Mergers not because they want to, but because they have to.
Exactly. You merge just to pool your capital together to survive the regulatory costs. You become a bigger bank, sure, but not a better one. You're just a larger zombie.
That's a bleak image. So let's look at the pivots. This is the exciting part. What are they doing differently?
This group, they realize the game has changed permanently. They stop trying to make all their money from net interest margin that's spread between deposit rates and lending rates. Instead, they switch to non-interest income. In other words, fees.
Okay, when you say fees, I think a lot of listeners might roll their eyes. Are we just talking about banks annoying us with higher ATM fees or trying to cross-sell us life insurance at the teller counter?
No, that's small potatoes. That's not going to move the needle on a billion-dollar balance sheet. We're talking about a structural change to capital-light revenue. The report outlines 3 massive pillars of this pivot.
Okay, let's go through them. Pillar 1.
Wealth management and private banking.
Which implies moving well beyond just taking deposits.
Right. Look at the demographics. Nepal has a growing mass affluent class. People have money, but they don't really know where to put it. Currently, banks just take that money as a deposit and pay them interest.
Which costs the bank money.
Exactly. The pivot banks will flip that entire model. They'll offer advisory services, estate planning, portfolio management services, or PMS. They manage the client's money for a fee rather than borrowing it.
Ah, I see the difference. If I manage your portfolio, I charge you, say, 1 or 2%. I don't need to hold any capital against your money because it's your risk, not mine.
Precisely. It uses almost zero of the bank's own capital, but generates steady, returning income. It's the holy grail of ROE.
Okay, pillar 2.
Corporate advisory. This is huge. Instead of just being a lender, the bank becomes a partner.
What does that look like in practice?
Let's say a big Nepali cement manufacturer wants to acquire a smaller competitor. A traditional bank would just say, how much money do you need? Okay, here's a loan.
And the pivot bank?
The pivot bank says, we will structure the deal for you. We'll value the target company. We will help you raise capital from the market. We'll handle the debt restructuring. They advise on the entire deal and take a hefty fee for their brainpower.
So they're selling expertise, not just renting out their balance sheet.
Exactly. It turns the borrower into a client. And again, advisory fees require zero regulatory capital.
And the third pillar.
Sophisticated transaction banking. This goes way beyond just issuing a letter of credit for a trader. We're talking about integrated supply chain financing, digital cash management solutions.
This sounds like a volume play.
It is. Imagine a bank providing a digital platform that handles every single payment, every invoice, and all the payroll transactions for a massive corporate group. They take a tiny sliver of a fee on every single transaction.
But because the volume is billions and billions of rupees,
The income is massive, and it's sticky. If a bank runs your entire payroll and supply chain system, you can't just leave them for another bank because they offer a 0.5% lower interest rate. You're locked in.
so this all seems kind of obvious. If this is the only way to survive and keep ROE high, why aren't all 20 banks doing this right now? Why does the report predict only a small group will actually pull it off?
Because it is incredibly hard. It requires a complete top-to-bottom cultural overhaul. I mean, think about the human element. For decades, a good banker in Nepal was someone who had good connections, could find a guy with land and give him a loan.
It was a relationship game.
Totally. Now, you need a banker who can advise on a complex merger or manage a high-net-worth portfolio or design a digital cash management system. Do you know how hard it is to find that kind of talent in Kathmandu?
Right. You can't just retrain a loan officer to be an investment banker over a weekend seminar.
No. You have to hire expensive talent, probably poaching them from abroad or from other sectors. You have to invest in really expensive technology. And here's the kicker, the thing that scares the CEOs. That investment, it depresses your profits in the short term.
So you have to be willing to lose money, or at least make less money today, in order to survive tomorrow.
And in a market that is obsessed with quarterly performance, where the board is screaming for dividends now, asking a CEO to sacrifice today's earnings for a payoff that's 3 years away, that takes serious conviction. That takes guts.
That's the real barrier. It isn't that they don't understand the strategy, it's that they might not have the stomach for the transition.
That's it, exactly. And that's why most people just try to consolidate and hide. They'll hope the storm passes. But under Basel III, this storm never passes. This is the new climate.
It really is a fork in the road.
It is. The report calls it the hard truth. The institutions that are going to thrive in the next decade won't be the ones with the biggest balance sheets. The size of the loan book used to be the scorecard, right? I have a bigger loan book than you, so I win. That's gone.
So what's the new scorecard?
Sophistication. The successful banks will be the ones who realize their most valuable asset is no longer their capital. It's their advice. It's the trust they build with clients to solve complex problems, not just fund them.
That is a profound shift from here is money to here is how you should manage your money.
It's the difference between being a utility, like the electricity company, and being a partner. Utilities get regulated and they get squeezed. Partners get paid.
And for you listening, whether you're an investor looking at bank stocks or a business owner looking for a bank, that is the filter you need to use. You need to ask yourself, is this institution a consolidator, just holding on to the past, or are they a pivot, building for the future?
That's the question that will determine the winners and losers of the Basel III Endgame.
We are going to leave it there. A tectonic shift indeed. Thanks for unpacking this with us.
My pleasure.
And thank you for listening to The Deep Dive. We'll see you next time.